Japan has just set off a chain reaction in the global economy, and the reason it matters is not because of any single announcement, headline, or emergency statement. It matters because of what Japan represents inside the global financial system and what happens when that role begins to change. This is not a sudden collapse, it's a shift in behavior. And in global markets, behavior changes long before outcomes do. For decades, Japan has acted as one of the most important stabilizing forces in global finance. Its ultra-low interest rates, predictable monetary policy, and deep bond markets allowed capital to move freely across borders. Investors borrowed cheaply in yen, deployed capital elsewhere, and assumed that Japan would remain the quiet anchor holding the system in place. That assumption shaped everything from currency markets to equity risk to global debt pricing. What has changed is not one policy decision, but the reliability of that assumption. When Japan alters how it manages its currency, its bond market, or its tolerance for volatility, the effects do not stay local. They ripple outward into leverage positions, funding models, and risk frameworks that were built on stability. These frameworks don't break instantly, they strain. And strain is what creates chain reactions. The first signs appear in currency behavior. The yen is not just another currency. It is the foundation of global carry trades. When the yen moves unpredictably, leverage positions across the world are forced to adjust. That adjustment doesn't require panic, it only requires uncertainty. And uncertainty is now entering a system that was designed around predictability. From there, pressure moves into bond markets. Japan is one of the largest holders of government debt globally. When yield expectations shift, even slightly, it forces a repricing of duration risk elsewhere. Investors begin asking whether other safe assumptions are equally fragile. Those questions don't create headlines, but they do change positioning. This is where liquidity starts to slow. Not disappear, slow. Market participants become more selective. Risk desks tighten limits. Market makers widen spreads. None of this looks dramatic in isolation, but together it changes how markets respond to stress. Small inputs begin producing larger reactions. Volatility no longer needs a shock to emerge. It feeds on caution. What makes this moment dangerous is how quiet it feels. There is no global shutdown. No official declaration of crisis. Markets are still trading. Prices are still moving. But the underlying rhythm has shifted. And rhythm matters more than direction. Japan's role has always been to absorb pressure rather than create it. When that role begins to weaken, even temporarily, the system loses a key stabilizer. Other markets must compensate. That compensation doesn't happen evenly. Some areas tighten, others overshoot. The result is fragmentation. Fragmentation is the early warning sign most people miss. This is not about whether the global economy is ending or collapsing. It's about speed. When a system loses its shock absorbers, adjustments happen faster and with less warning. Moves that once took months now unfold in weeks. Reversals become sharper, recovery becomes conditional. The chain reaction has already begun, not because Japan intended to trigger it, but because the global system was built assuming Japan would always behave the same way. Systems rarely survive unchanged when their assumptions are challenged. History shows that when Japan's role shifts, global markets don't immediately break, they recalibrate. And recalibration is uncomfortable because it removes certainty. Participants stop relying on old signals. They shorten time horizons. They reduce exposure earlier. They react rather than wait. This is why the reaction feels global even though the source is local. What happens next will not be defined by one market or one asset. It will be defined by how quickly participants recognize that the environment has changed. Those who continue operating as if nothing has shifted will feel the adjustment most sharply. Those who understand that the chain reaction is structural, not emotional, will at least understand what they're seeing. The most important takeaway is this: global economies don't freeze overnight. They slow first. And slowing is often more disruptive than collapse because it changes incentives, behavior, and expectations at the same time. Japan has just reminded the world how interconnected the system really is. And once a chain reaction starts, it doesn't need noise to continue. The reason this chain reaction is so difficult to recognize in real time is because it doesn't begin where most people are looking. It doesn't start with collapsing stock prices or emergency headlines. It starts inside balance sheets, funding assumptions, and risk models that quietly lose their reliability. Japan sits at the center of many of those models, which is why even subtle shifts there have outsized consequences elsewhere. Global markets have spent years operating in an environment where Japanese policy acted as a constant. Low yields in Japan didn't just support domestic borrowing. They underpinned global leverage. Capital flowed outward because it could. Risk was taken because it was cheap to finance. Entire strategies were built on the idea that Japan would remain predictable, even if everything else became volatile. When predictability weakens, leverage becomes uncomfortable. This discomfort shows up first in how institutions manage exposure. They don't wait for confirmation that something is wrong. They respond to the probability that conditions could change faster than expected. Positions are reduced. Hedges are adjusted. Duration risk is shortened. None of this signals panic, but all of it changes market behavior. As this happens, correlations begin to shift. Assets that once moved independently start reacting to the same signals. Liquidity becomes more selective, not because it disappears, but because it demands clarity. Market participants become less willing to absorb risk without compensation. That compensation takes the form of volatility. Japan's influence extends deeply into sovereign debt markets, and this is where the chain reaction becomes harder to contain. When yields in one major market become less anchored, global benchmarks adjust. Investors reassess what risk-free actually means. Even small repricings in these assumptions can cascade through portfolios that rely on stability. This is why the impact feels disproportionate to the trigger. Another subtle effect emerges in timing. Markets become less patient. Under stable conditions, time allows uncertainty to resolve. Under shifting conditions, time increases exposure. Participants prefer to act sooner rather than later, which compresses decision-making and accelerates reactions. Moves happen closer together. Reversals feel sharper. Calm periods feel temporary. None of this requires a crisis. It only requires adjustment. Japan's role has always been to smooth volatility, not amplify it. When that smoothing function weakens, other markets must absorb more shock. Some can, others can't. The resulting imbalance is what creates the sense that something is unfolding, even if it hasn't yet been named. This is why the global economy appears to be reacting without a clear cause. The cause isn't a single event. It's the erosion of a stabilizing assumption. And once that erosion begins, it doesn't reverse easily. We are now in the phase where the system is testing its own resilience. Markets are probing for weak points, not consciously, but through behavior. Reactions are faster. Margins for error are smaller, the tolerance for surprise is lower. That is how chain reactions actually work. They don't explode at once. They propagate quietly through the structures that were designed to prevent them. As this propagation continues, the most telling change is not found in prices themselves, but in how markets respond to uncertainty. Under normal conditions, uncertainty invites patience. Participants wait for clarity. They look for confirmation. They allow systems to self-correct. But when a stabilizing force like Japan begins to behave differently, Uncertainty no longer invites waiting, it invites action. This is where the chain reaction gains momentum. Risk models are built on historical behavior. They assume that certain relationships will hold because they always have. Japan's role as a source of cheap, predictable funding is embedded into those models. When that role becomes less reliable, even temporarily, the models don't fail outright. They produce wider ranges. Wider ranges force more conservative decisions. Conservative decisions reduce liquidity. Reduced liquidity doesn't stop markets. It changes their texture. Movements become sharper. Transitions become faster. What once unfolded gradually now compresses into shorter time frames. This is why markets can feel suddenly more reactive without any obvious trigger. The trigger isn't new information. It's the realization that old information can no longer be trusted in the same way. Another effect appears in global capital flows. Japan's influence has long encouraged outward movement of capital, supporting assets and risk-taking elsewhere. When that flow becomes less certain, capital doesn't necessarily rush home, it hesitates. And hesitation alters behavior everywhere it touches. Investment decisions become more selective. Exposure becomes more tactical. Long-term assumptions give way to short-term caution. This is particularly destabilizing for systems built on continuity. Supply chains, funding structures, and debt markets all depend on the idea that tomorrow will resemble today closely enough to plan around it. When that resemblance weakens, even slightly, the cost of planning rises. And when planning becomes expensive, activity slows. Slowing is not collapse, but it is disruptive. What makes this phase difficult is that it lacks a clear narrative. There is no single cause to point to, no moment to label as the start. Observers search for explanations in data releases or policy statements, but the real driver is behavioral. The system is adjusting to a new range of outcomes, and that adjustment creates friction. Friction shows up as volatility, misalignment, and inconsistency. Assets that once moved smoothly now jerk unpredictably. Correlations that once provided diversification weaken. Hedging strategies lose precision. These are not signs of failure. They are signs of transition. Japan's position ensures that this transition cannot remain isolated. Its connections run through currencies, bonds, equities, and funding markets. When one node adjusts, the network responds. That response doesn't require coordination. It emerges naturally from the way incentives shift. This is why the reaction feels global even when the changes appear subtle. The system is interconnected enough that small deviations propagate quickly. And once participants sense that propagation, behavior changes again, feedback loops form. Caution reinforces caution. At this stage, the chain reaction is no longer about Japan alone. It's about how global markets respond when a key stabilizer becomes conditional rather than absolute. That conditionality is uncomfortable because it forces participants to confront uncertainty they didn't previously price in. And once uncertainty is priced in, it rarely leaves quietly. We are now beyond the point where this can be dismissed as noise. The system is adapting in real time. The question is no longer whether the chain reaction exists, but how far it will travel before a new balance is found. As the adjustment deepens, the most important shift becomes psychological rather than mechanical. Markets are no longer reacting to Japan as a single source of risk. They are reacting to the realization that stability itself is becoming conditional. For a system built on predictability, that realization is destabilizing even without any dramatic event. This is the phase where expectations quietly reset. Participants begin operating under a different internal rule set. Instead of assuming that central banks, deep bond markets, or established funding channels will automatically absorb stress, they assume that absorption may be slower, uneven, or incomplete. That assumption changes how much risk they are willing to hold and how long they are willing to hold it. Time horizons shorten, exit thresholds lower, tolerance for surprise declines. Liquidity still exists, but it behaves differently. It becomes situational rather than continuous. Market makers participate, but they do so with tighter parameters. They step away more quickly when conditions feel uncertain. As a result, price moves require less force to travel further. What once felt like normal fluctuation now feels exaggerated, even though underlying volumes may not have changed much. Japan's importance in this phase lies in what it represents symbolically. For years, it embodied the idea that some parts of the system were permanently stable. When that idea weakens, it doesn't just affect Japan-related assets. It forces a broader reassessment of which assumptions can still be trusted. That reassessment spreads slowly but persistently. Another consequence is the way markets respond to interruptions. Holidays, data releases, geopolitical headlines, or minor policy signals carry more weight than they used to. Each interruption becomes a stress test rather than background noise. The system reacts more sharply, not because the input is larger, but because the margin for error has narrowed. This narrowing margin is what gives the global economy its uneasy feel. Growth doesn't stop. Trade doesn't freeze overnight. But the system becomes more cautious. Investment decisions are delayed, capital allocation becomes more selective. Risk-taking shifts from expansive to defensive. These changes don't make headlines, but they compound over time. Importantly, this phase is often misread as overreaction. Commentators argue that markets are being too sensitive, that fundamentals remain intact. But sensitivity itself is a signal. It indicates that confidence has been recalibrated downward. Once that happens, behavior does not revert quickly, even if conditions stabilize. We are now in the middle of that recalibration. The chain reaction is no longer spreading through surprise. It is spreading through adaptation. Participants are learning to operate in an environment where one of the system's key anchors can no longer be taken for granted. History suggests that once markets reach this point, resolution does not come from a single corrective move. It comes from acceptance. Acceptance that the old equilibrium has shifted and that a new one must be discovered through experience rather than assumption. That discovery process is rarely smooth. It involves false starts, sharp reactions, and periods of apparent calm that mask underlying tension, but it is also how systems survive change. Japan has not ended the global economy. It has altered the conditions under which the global economy operates. And when conditions change, behavior follows. As this process reaches its final stage, what becomes clear is that the global economy has not been pushed into crisis, but into reassessment. That distinction matters. Crises are sudden and visible. Reassessments are slow, quiet, and far more disruptive over time. What Japan has triggered is not a breakdown, but a shift in how risk, stability, and confidence are understood across the system. By now, the chain reaction is no longer driven by surprise. It is driven by adjustment. Markets have begun to internalize the idea that one of their most reliable anchors can no longer be treated as automatic. Japan's role has moved from being an unquestioned constant to a variable that must be watched. That single change forces a broader rethink, because global systems are built on layers of assumptions, not isolated facts. At this stage, behavior matters more than data. Participants are not waiting for confirmation that something is wrong. They are responding to the possibility that something could change faster than expected. This mindset alters decision-making everywhere. Exposure is reduced earlier. Hedging becomes more conservative. Long-term commitments are scrutinized more closely. None of this looks dramatic, but all of it slows the system. Slowing does not mean freezing. It means friction. Friction shows up in subtle ways. Capital becomes more selective about where it flows. Funding becomes more conditional. Risk-taking becomes episodic rather than continuous. Markets still function, but they do so with less tolerance for error. Small miscalculations carry larger consequences. Recovery becomes less automatic and more dependent on confidence returning. This is why the global economy can feel unstable even when growth indicators appear intact. The instability is not in output, but in expectations. Expectations drive behavior, and behavior drives outcomes. Once expectations change, the system cannot simply revert to its previous state by wishing stability back into existence. Japan's role in this moment is not about intention. It is about position. When a system stabilizer becomes conditional, everything connected to it must adapt. That adaptation is uneven. Some participants adjust quickly. Others hold on to old assumptions longer than they should. The mismatch between those responses is what creates volatility. History shows that these periods are not resolved by one decisive event. They are resolved by normalization under new rules. Over time, markets discover a new balance point. That balance often looks less efficient, less liquid, and more cautious than before, but it is also more honest about risk. The danger lies in misreading this phase as temporary noise. Treating it as something that will simply pass ignores the deeper lesson. Global systems evolve when their assumptions are tested. They do not revert. They recalibrate. What Japan has done is force that recalibration into motion. The chain reaction is not about collapse. It is about consequence. Consequence of leverage built on certainty. Consequence of risk priced too cheaply for too long. Consequence of assuming that stability is permanent. The most important takeaway is not a prediction about markets, currencies, or growth. It is awareness. Awareness that the global economy is entering a phase where behavior matters more than policy statements and structure matters more than headlines. Those who understand this are not trying to forecast every move. They are trying to understand the environment they are operating in. And in moments like this, understanding is the only real advantage. The chain reaction has already begun. What happens next will not be sudden, but it will be lasting.